All right. Well, welcome everyone to the Financial Literacy Workshop. I very much appreciate everyone making it. I realize that in the middle of the day, not everyone has the time, so it's fantastic to have you all here. Yay, look at how pretty that is.
I love the colors, John. Let me just say those colors are actually my logo colors. So
I'd love to say I did that on purpose. I totally didn't, but I'm so glad that you liked them. So again, welcome everyone to the class. Today we're going to be talking about quite a few things in the hope to bring everyone a little bit better in with financial literacy, understanding our own finances. What we will discuss, we're going to be talking about equality versus equity. We will be talking about setting goals. We will be talking about the sort of real estate side as well. I'll be talking about budgeting and how credit impacts our lives, both in getting loans that we're interested in and not being in terrible debt and how that sort of works. And then, more importantly, we're going to be talking about building the financial pillars for success and how to go about doing that. Now, before we get into all that fun bits, a little bit of introductions. So who is it that's going to be talking about all this? Well, I mentioned quite a few of that. So the real estate portion is going to be being taught by Dee, who will introduce herself here in just a moment. The budgeting side, both the budgeting and the credit side, will be introduced by myself. My name is Jonathan Woelfle, and I am with Fairway Independent Mortgage. I am a lender, and so hence the talking about budgeting and how that sort of section works, as well as credit, because gee, what do you know? I probably look at a few credit reports, or a million of them, every single day, and I can help you in either building your credit and understanding what your credit is made of. I have been in this industry. I originally got in this industry in 2005, and in the financial services industry even earlier than that. And we decided to start teaching this class because I at least know for me, I knew nothing about any of this stuff when I was first starting. I just want to make sure that I'm not the only one, and hopefully everyone will have a little bit better idea of how to build your financial future, so that when you get to a point of either being my age in your 40s, or by the time you hit retirement age, you will be ready and prepared for that. Dee, please introduce yourself.
Hi, everybody. It's Dee Shirky with Dee Real Estate Group, Keller Williams, and we are so excited to bring you this class today. You know, we were originally supposed to be doing this class in the first part of March, and then COVID happened, and then we had the murder of George Floyd, and that what it really did was bring an awakening to us about what was necessary and what we actually needed to be talking about. So we actually blew up our first presentation. And, you know, as the recent social equality ambassador for the Northwest region of Keller Williams, I felt that it was important for us to change the narrative and change the conversation. It is all our desire, all three of us desire to make sure that we are trailblazers in helping bring equality and equity into real estate, the lending, and the investment side. And so we're going to be talking about what that looks like, particularly with what is happening in the climate of our society right now, and the three of us understanding that there is the playing field is not equal in this race, if you will. And so again, we want to be able to be the ones that can help bridge that gap. So we're going to be talking about real estate and why it is important for you to purchase and how that can help build generational wealth to your families. Jonathan's going to be talking about lending. David's going to be talking about the investment, and we really want to encourage everybody to start where you are, whether you have $5 in the bank or 20,000 or 100,000, wherever you are, this is going to be a great webinar for you.
Hey, and David, please introduce yourself as well.
Hi, everybody. David Hooper, Kingsview Wealth Management. I am an independent registered investment advisor. I'm very honored that Dee Dee and Jonathan asked me to participate in the financial planning and investment management component of this presentation. And I really like what Dee Dee said as we started this a few months ago, really kind of thinking about what it was going to look like and blew it all up and said, hey, we really need to educate people. I think that's a great way kind of take that first step of knowing where we can kind of move, what are some good frameworks for setting up the various topics that we're going to cover today. But yeah, just really, really excited to be part of this. Very, very honored to be part of it. I'm looking forward to going through it and continuing the discussion.
Yeah.
So our first side we're going to be talking about is the real estate side, and I'm going to be passing this one off to Dee Dee. Dee Dee, if you can start us off and let me know if you want me to forward those slides.
Okay, you go ahead and click to the next one. So home ownership is my jam. Home ownership is my thing. And I have been privileged to help my family get into their first and second homes. And the beauty of where we are, even as a unit, is we're now starting to talk about investments and investment properties. But we really had to start at square one, right? What are our long-term goals? And I'm talking my extended family from mom, dad, cousins, aunts, and uncles. Where do we want to be as a family? How do we make sure that our children don't start from ground zero? And the fact of the matter is that everybody is going to have to pay to lay their head somewhere, right? So let's at least start moving to equity, right? And how do we get there? So for me, it's, I have to understand for my clients, what is the goal? My passion definitely is to help generational wealth. And that could mean a myriad of different things and age demographics. So when you're walking into, or have a thought of, I want to buy a home, it's really, really important to understand what your end goal is going to be. What actually do you want out of this? Maybe you're in your golden season and say, hey, this is it. I need a rambler. My knees are not doing any more split levels, 2 stories. I've done that. I've done the whole big yard thing with all the I'm not doing that anymore. So give me something that is kneecap friendly, with a small yard, little to no grass. So those goals are important. Next slide. And we're not going to park here very long because this is the part, John, we teach this class and this is one of the slides we teach that we talk about and how, this is a little bit of a downer, but I want us to go down to the $1,900 a month rent, right? And in 3 years, you have given someone $68,400, right? You have written a check to lay your head for that amount of money in the past 3 years. John, and I'm going to throw this question back at you. What does that look like for mortgage, right? Because at some point, I'll back up. In Seattle, in Washington State average, we have grown in our equity, in our housing equity between 10 to 12 conservatively % every single year. So if you're buying a property at 300,000, 10% in 12 months is you have grown your equity by $30,000, right? What are some of the benefits of that home ownership for 3 years?
There are numerous benefits. One of the biggest ones is, of course, that equity. So, if you're talking about 10%, that's with compound interest, that's about almost $100,000 that you've actually built up over that time. I don't think that's going to be consistent over length of time, but the key is you're building equity that you wouldn't have otherwise. Plus, you're actually, when you're making your mortgage payment, you're making a mortgage payment on that, and that's actually going down over time. That 1,900 number, that is probably about a $300,000 purchase right there.
Yeah.
So that's kind of crazy when you look at that, of how much of that money you're literally giving away. And when we talk about financial literacy and trying to make sure that you're in a good place for retirement, which I know David will talk about better. One of the things that they talk about is having your house paid off, not having a mortgage payment. In this land of debt that we live in, being debt free and having that completely gone is going to make retirement a lot easier for yourself.
Yeah. Yeah.
Can I just add one other thing real quick
Absolutely.
to that rent versus owning? It's also interesting, and Jonathan, correct me if I go off the rails, but it's like the nice thing about having a mortgage is at least your principal and interest payment, that's set for the life of your mortgage, versus who knows when your landlord's going to knock on your door and increase the rent. So you have less certainty on what your ongoing payment's going to be today, tomorrow, in the future, versus that rent can always adjust, versus your principal and interest of your mortgage is going to stay consistent for the life of the loan.
Which allows you to plan for your future a lot better. It's funny because I tell people, like, when I pay for, a house I bought many years ago, and they're like, wait, you own this house and that's all you're paying? I'm like, right, but that's the difference. Like, it's been set for all these years and I don't have to worry about it. So
Right.
Yeah.
And going back to the renting, and I think there's this, we're going to go to a slide that has the rent versus own. But I would challenge those that believe that renting is better. When has rent gone down overall as a whole, right? Like when has your landlord came by and said, hey, you know what, 1,900, I'm going to go ahead and drop that to 1,500. How about that? Right? Like that. That's a blessing.
For mortgages, that's the exact opposite, where, right now I'm in a very busy time of refinances because interest rates have gone down and people are trying to lower their monthly payment on their house. It's a much different story than your rent going up. So, yeah.
Yep. Great.
Want to go next slide?
Yep. So the next slide. Yeah. So we touched a little bit about that renting versus owning, and we've had a handful, John, of clients that said, hey, I was getting ready to renew my lease and my landlord gave me a 30-day notice. Hey, I'm not renewing your lease. And so now they have 30 days to find a place to stay. They have to have a deposit, and God knows what else, right? And so when you are owning, you definitely have more control of how you're able to move around, for sure. For sure.
There are benefits of renting, such as not having to worry about people. If your garbage disposal goes out, you have a landlord, they'll come by and they'll fix it. But versus owning, where you can actually make it your own.
Yeah. And when you're owning, and one of the things that I do for my clients, that I always make sure that you have a home warranty. So if your garbage disposal goes out for $75, the home warranty will come out and repair or replace your garbage disposal. So 1 point for Dee Dee.
There's also some tax benefits to owning as well, where you get to write off some of your mortgage interest.
Yeah.
And any taxes you're paying on it, because there are property taxes involved, and that's set up as part of your payment. So don't get me wrong. Are there benefits to renting? I've heard them all. Yes, but long term, I don't really see it.
Yeah, and I'll give my own story. I bought a townhouse. It'll be almost 4 years. Come October, maybe 5. No, maybe 4. I don't know, somewhere around there. And came in, had this ugly green Christmas carpet on the first level, this burgundy carpet on the second level, pink salmon walls, and I knew that my rent was not going to get any cheaper than it was. And I knew that I needed to put myself in a position to build equity. Why? Because I have 2 children that are right now eating the out of house and home, and they're growing, right? So every 3 to 6 months, someone's having a growth spurt somewhere where we need an entire new wardrobe. And, they need stuff, hey mom, this project's due tomorrow. Can you please go by and drop $50 on whatever products I need? So life is happening. And I can say that in less than 5 years, I have built over $150,000 worth of equity, right? So now I'm on the second tier, second step to being able to purchase another home, to be able to really start diversifying my assets with the equity that I've had just because I bought something that I needed a place to lay my head with me and my kids. So you hit that screen there. So when we're talking about real estate, it really is important to have a conversation, whether it's by yourself. You need to set priorities. If you have a spouse, a significant other, a partner, or a family member, or even an investment, if this is investment property, setting priorities is really, really important. And your priorities also need to be in alignment with your goals and your approval letter. So I say approval letter because you may have some great priorities and they may not match your approval letter, right? So your number one priority may be, hey, I really want to live in Bellevue. I need a 3-bedroom, 2-bath with a 2-car garage. And if your approval letter says that you are approved for $350,000, we have a gap between what your priorities are, what you really want, and your approval letters. So when you sit down with your real estate agent, it's the setting your priorities, that agent understanding your goals and helping you move maybe to Bellevue, maybe not at this house, but down the road, having a 5 to 10 year plan. That's important. Jon, I'm going to ask you a couple of questions about this wish list, right? So this is something that I send out to my clients. It's what are your wants and your needs? How many bedrooms? How many bathrooms? What's important to you? Commute, schools, crime. What do you say to your clients when your approval that you just issued doesn't quite match what they want?
So I tend to ask the same questions to almost every client of mine, which is one, when you're thinking about buying a house, what is comfortable for your budget? You really don't want to be house poor, especially when we're talking about finances and setting up for your future. You want all your money going into your home so that you don't have any money for your retirement, any money for living life, etc.
Yeah.
The other question I end up asking is, when you're thinking about buying a house, what is that price range you've been looking at? Because what I'm really looking at is I sometimes will get people who will say, my comfort zone's $1,000 a month. I'm like, okay. And then what's that area? Like, well, I want to buy a house for 450, 550,000. And those are not in the same place.
Unless you're putting $200,000 down, right?
Yeah.
Which can happen.
It changes my scenario by a lot.
Mm-hmm.
So that tends to be a very important one. And then usually the conversation starts being, so because maybe we're pre-approved at 350,000, can you buy a house? Absolutely. Is it perhaps the house you're looking for? Not necessarily. And I think sometimes it's an important discussion to talk about having that starter home. When I first bought a house, I didn't buy my dream house. I bought a condo. I bought a 2-bedroom, 1-bath, 750 square foot condo. And then I lived there for a few years and sold that one, and then bought. Then I ended up buying a house that was 4 bedrooms and 1.5 bath, and it's you build up to this until you have the home that is your dream. Nobody likes hearing that, but I mean, I think that we're going to touch upon that quite a bit when David is talking about sort of those pillars of financial success as well.
Yeah, and I think part of the misnomer is I want to get into a home. Well, depending on what season in life you are in, that is going to be this forever home, and I'm just going to live here forever and ever and ever. And the fact of the matter is, statistically, people stay in their home between 5 and 7 years, right? And so, what does that look like? If we understand that, then maybe you, if you're solo or you and your partner, we have a conversation about what are the top 3 things that are really, really important to you. If it's, hey, I have a preschooler and they're getting ready to head into, kindergarten to 1st grade. So school is really, really important to me. Then we we really talk about how do we get you there. So we set you up for success for the next 5 years. Maybe it's not the perfect home, but it is the perfect home for you. And we can springboard that equity and launch you into maybe phase 2. And maybe phase 2, you're there for 7 to 10 years, right? So those are the things that we talk about. So we have a wish list that we always have. Yes, we wish that we had this, that, and the other. And then what's our real need? It goes back to our goal. You know, can I get you into something that maybe, you know, is got great bones, but it's got the ugly green shag carpet that you can rip out, you know, for, you know, a couple grand. And now you're not looking at that anymore. You're looking at some beautiful vinyl or some, you know, Pergo or whatever it is. So it's important, again, to have your wish list really match your goals and match that approval letter.
I think this is great. Can I just ask one question? Not to put you on the spot, but can you think of some of like sort of off the sort of rail priorities that people have had? Like, I don't know if like anything. So, you know what I'm saying? I just think it'd be funny because I get the same thing in my world. Like, wow, I hadn't thought of that.
Yep. So, one couple, he was in construction. And he was like, I don't care what the house looks like. I just need a bathtub in the master so that when I get home, I don't see anybody for an hour. I need to smoke because I've been breaking bricks, right? A garden, a space for a garden has been important. I'm trying to think of something that was really crazy.
It's just kind of
crazy offhand, but and what's interesting, especially if you're talking partners, there are, you know, you have two people that have potentially two very, very strong needs. So sometimes that journey blows up and then we have to restructure to really figure out what are the two things that you can compromise on to create that unity with the two of you to say, hey, we've talked about this after the last blowout. Sorry, you had to see that, right? Because that's life. Buying and selling a home is emotional. So if you don't think that a couple may not blow up at some point, you're lying to yourself. And I've just been, you know, blessed to be able to see it. And it's like, hey guys, it's okay. Like, we're all human. You know, you have two people that have two different needs. And then I just tell them, let's take a couple day break. You guys go home and write out what your needs are, come up with the top two, and let's figure it out. And I always say, you know, my only stipulation with couples or partners is that you have to leave the way you came, which is together. We're all in this together.
These the home wish list really ends up tying into so much of everything else that we're talking about, from budgeting to retirement, of really having that sit down of like, what's really important to you. And it's so funny because, I mean, having those conversations. I remember when buying a house, the biggest concern for her was that we kept coming up was the garage for whatever reason. Like, it was really important to her that she had somewhere where she could park her car. And I didn't care really. That was not an important factor for me, but it was super important for her. And whatever it was, she didn't want to be able to see the garage being the first thing that you saw. It had to be something that was sort of in the back or something. I was like, really? All right. And then the other one that was really important when we talked about finances was, she's like, I'm fine with whatever we do for finances and keeping, et cetera, but I want to make sure that we have one nice vacation a year.
Yep.
I want one nice week where we're going somewhere special that we're not like pinching pennies. We can pinch pennies all year long as long as we have 1 week, 1 day. I'm like, okay. And that was the priority. And making sure you have those realistic conversations, whether it be your home wish list, your finances, it's so important. And it can be a really tough conversation to have, especially in relationships.
Absolutely. Absolutely. So make sure you're on the same page if you have a partner with your wish list.
Well, I think, did you have anything else you wanted to add, Dee Dee, before we skipped over to budgeting?
Nope.
Okay.
I think that's about it.
I'm sure you'll have some questions for us as we're going through.
I absolutely will. Absolutely.
All right. Well, I'm going to be talking about some precursor stuff that we've sort of talked about up to this point, which is budgeting basics. Why is budgeting so important? Well, it can be important for numerous reasons. One is because maybe your goal is to buy a house and that's where you're at, or maybe you already own your house and you're looking at your retirement, and you're getting back some numbers from your HR that says, yeah, you're really low in your retirement, or you think you're doing fantastic, and but there's other factors to take into account. So we're going to be talking about setting some financial goals. You were talking about that earlier. One of the first financial goals you should have is eliminating debt. Now, I do realize the hilarity of that statement coming from a lender who, let's face it, is going to probably give you more debt than probably anyone else could possibly give you. But the goal for even buying a house should be eventually to pay it off. By the time you hit retirement age, hopefully you don't have a debt. You have no mortgage payment, and that's completely taken care of. After you have, focused on eliminating your debt and getting rid of that, one of your next goals should be having 6 months of expenses saved. And what this is meant to do is to make sure that you have enough there to handle problems that may arise, because life is tricky. It
Absolutely.
is. And it's a hard one to sometimes manage. And you're going to have things pop up, whether you own your own home or not, where maybe your mom is having some major health issues and you need to take some time off of work to help her. Or maybe you're having some health issues and you need to take some time off of work. Or there was a car accident, or the myriad of stuff that ends up happening in life. And are you able to handle whatever that case may be? And that's what that 6 months of expenses saved is really all about. You also want to end up having some investment goals, which obviously Dave is going to talk about in great detail. But thinking of your investment goals or thinking of your savings, a lot of people look at that like it's some sort of extra. More often than not, what I end up hearing from people when they're trying to budget for either buying a house or trying to budget for retirement, whatever they're budgeting for, or even vacation, it is, I'm budgeting with my extra money. I spend all this money, and whatever I haven't spent, that's my savings. You should be thinking of your savings like any other expense. You have a power bill, right? And you pay your power bill on time. You have a car payment, you pay that on time. You have your rent or your mortgage, you pay that on time. Why wouldn't you think of your savings as being the same one? If this is an expense every single month, it's in my budget, and I'm paying myself every single month. And it's important to have that. Now, I know in the beginning it says 10% of all income saved or invested. You should be setting aside a minimum of 10% of your income towards your savings or towards your retirement investments, etc. But keep in mind, that doesn't necessarily have to all be coming from you. Most people who work for another company, they have this lovely thing called a 401k. They have this lovely thing where your company will match a certain percentage. Find out what that matching is. If you want to give yourself a raise, one of the easiest ways of doing it is find out what that max percentage is and hit that number. Long time ago in a galaxy far, far away, I used to work for Wells Fargo. I know David can say the same. One thing I love that Wells Fargo did was they actually matched you up to 6% of whatever you set aside towards your retirement. And I did that. I ended up setting aside 6% of my own income. They matched that. So I had 12% of every dollar I made going towards that. Well, I work for Fairway Independent Mortgage and have for just about 4 years now. And in working for them, they don't match the full 6%. They actually only match 3%. But I did say I kind of like having that 12%. So now I set aside 9% of every dollar I make. They match the 3%, so I still have that 12% going. Now, guys, is that easy to do? It's not. There's nothing easy about that. You really have to start figuring out what's important to you on your budgeting. But I do it every single time, and it's set up as an automatic thing. It's not something I think about. It's not something I'm trying to focus on. It's set up automatically to come out of my account no matter what. I actually do the same thing for a lot of my nonprofit stuff that I give away. I automatically have a certain portion of my money going towards certain nonprofits that are important to me. So I don't have to think about it. It just automatically happens. But, making sure that you are treating that like an expense is going to be huge for you.
Can I ask this, John? So when you were talking about budgeting, right, and it says, save 10%, and what happens if I'm looking at my budget and my budget is tight? And I guess my question is, should that be a deterrent to me purchasing a home right now, right? If I'm paying, $1,900 to $2,400, $2,500 a month to lay my head, and maybe I don't have the additional 10% that I'm saving or that I can save, should I be purchasing?
So that actually is touches upon kind of what we talked about before, equality versus equity, because there's a big difference. Equality is where everyone's paying 10% taxes across the board. And so you have the person who's making $20,000 a year paying 10%. You have the person making $100,000 a year paying 10%, and the multimillionaire guy paying 10%. That would be equal. Hey, everyone's equally paying the same. But that's not real equity, because that's not everyone on the same boat.
Right.
Luckily, there's a lot of different programs out there for, say, buying a house, and there's also different programs out there for retirement that are helpful to those who are in need. So, and when it comes to buying a house, you have things like the Home Advantage Program, House Key. These are down payment assistance programs that help you based on your income. If you're making less money, you get a much better interest rate, as well as your down payment paid for you through some of these programs. I did have somebody come to me, actually, I think they were in our class together. I just recall it being rather like, I'm not quite sure I'm understanding this. They're making over $245,000 a year between the husband and wife, and they spent it all of it. And then they ended up asking us, said, well, who's out there to really help us? Like, how are we supposed to buy a house? How are we supposed to come up with the 3% down payment to buy a house when we already spend it all? And I'm like, well, I agree. You're right that maybe there's something that there should be some sort of balance there. But honestly, you make $245,000. Right. There's other people in this class who are making $60,000 a year. They're the ones who need the down payment assistance. They're the ones who, need that extra help because they have 3 kids and 2 of them are teenagers. And just like you, Dee Dee, they're eating them out of house and home.
And home. Mm-hmm.
And it's we're totally different realms. So there's a lot of programs out there to end up helping. And in that case, you don't necessarily need to save up for all of it, like the down payment. And how do you find that one out? Sitting down with your experts, being, which I know David will talk about, having someone important, like having your financial advisor, having a real estate professional that you can rely on, who lives their life in integrity, having a good lender who can help to advise you on what your options are. Building that team, having that team is so important.
Yeah. And so I just wanted to make that very clear that maybe you don't have all the money that you need in your savings. It should not stop you from pursuing that home ownership. And maybe you don't have the best credit, right? I would rather see you get into something with maybe a lower credit score and get your foot in the door and start building equity than to take another year or two to wait till you're in the 800 club. And now you've missed this opportunity to have built potentially $30,000+ worth of equity because you're waiting on the perfect credit or the perfect storm.
Right.
And the time really is now. So, yeah, that's my 2 cents, my 3 cents.
Well, I just want to add my 2 cents real quick too, because I know, Jonathan, you've mentioned that there are a whole variety of different programs that I don't think the general public is that familiar with. So it goes back to, like you were saying, of really connecting with you, Jonathan, in regards to what are some of the other mortgage programs that individuals might qualify for. Just, I think it's a lot of what we were saying before, just educating. Like, hey, these are some options out there, and educating and motivating. Of like, hey, this information is out there. Let's go get you to do it. That's actually one thing I just jotted down, Jonathan, is I think a little bit of homework from this is everybody should call their HR or contact their HR department and learn more about their retirement plan and see if there's some programs or there's some advantages they're not currently taking advantage of, and they should help themselves kind of learn about it. So
yeah.
I agree. Well, the screen you have in front of you is the ABC in your budget. And this is just sort of a fun one you can sort of put together and see what that looks like. The way this would work on the ABC Your Budget is you look at your statement. Too often we have this idea of I have a budget and I'm abiding by my budget and everything's good. And then you look at your account at the end of the month and you're like, where'd the money go? Right. And unlike back in the day, and we really weren't paying that much attention, we have this new thing called these debit cards, called these credit cards, that tell us exactly what we're spending our money on. And it helps you to realize where your true importance is. Every single month, we do this voting thing. We vote on what's important to us in our life, and we do this $1 at a time. And too often, we're just not aware of what we're voting as being the most important thing. And the ABCs will help you with that. So let's say you get out your bank statement, you get that one out, or maybe it's your credit card, maybe you're using that to build up the points or whatever you're using. And then you start putting ABC throughout. A being expenses that you need and can do nothing about today, such as like your mortgage, your rent, your car payment. These are a fixed payment. These aren't going to shift. These are things that you have to pay no matter what. Others can be expenses you need, but maybe you can do something about today. So like groceries, do you need to buy groceries? Absolutely. Do you need to drop $1,200 a month on groceries? Maybe you can change
kids. That. You got 2 kids though.
Stuff, John. I don't know.
You got 2 teenagers.
I don't know.
You're doing your grocery shopping at Whole Foods, which is fantastic. But they do have an organic section at Winco as well as at Safeway. Just saying.
And we kill it every time. Winco and Safeway and Fred Meyer. And yeah.
So having some of those options, clothing, you absolutely need to have clothing, especially with some of those growth spurts. Do you necessarily have to have every brand new Nike shoe that comes out? Maybe not. So maybe it's possible to amend some of those things. And then others are things that you want but don't necessarily need, such as cable TV. I know we all love the HBO Max, but do you have to have the HBO? Do you have to end up having the ESPN package, etc.? Lattes, maybe you can make that latte at home. Movies, nobody's
taste the same though. These lattes don't taste. I said the lattes don't taste the same when you make them at home. At least for me. But I have cut back. I've cut back.
So that's more in your A. That's in your A category.
Right. Right.
And the other one we mentioned on is eating at restaurants. So it's funny because we so rarely go out now, but I've noticed my Uber eating has definitely gone up a lot in the past few months with coronavirus.
Yep.
It's a real thing. And that's the key is when you're going through, you start realizing where you're really spending your money. And then you get to start saying, all right, you know what? Maybe some of these things aren't as important to me. Maybe that guitar lesson thing I ended up signing up for a year ago and haven't taken a single lesson since then. Maybe that's not necessarily something I have to end up continuing to pay for.
Well, and I think, John, it's important that we are real with ourselves about where we are in this, right? Because if we're real about this, then probably there might be some of those C's that are somehow at the A, like they're the priority, and that we need to restructure and reprioritize, where we're actually spending our money. I don't like looking at my bank account sometimes. Because I'm like, I already know what it is, okay? I didn't do the right thing this month. I'm going to really do better next month. It was a busy week. And if how many times we just did the Uber Eats, or I got something to go because I didn't feel like cooking, or, my kids have done an amazing job. They do cook. But after they cook, the kitchen looks like Hell's Kitchen. Like, what did you guys cook on the floor? What happened? Right? And then it's 2 hours anyway. So we are working on C. I do feel a little conviction right now, but we're working on the C.
It's really funny because as a part of that one, when I was first doing this and figuring out exactly what I'm spending my money on and et cetera, I was shocked at some of the things that are popping up. Some of the things I was like, oh, when did that happen? Why am I, like, I didn't realize how much I was going out to dinner. It's my one vice, to be sure, which is you say, hey, John, we need to buy a brand new vacuum cleaner. I'm going to spend the next 4 to 6 hours researching the best vacuum cleaner to have, best one on budget. It drives significant other right up the wall. That said, when it comes to eating in a restaurant, someone says, oh, did you want to grab dinner over at Applebee's? I'm like, yes. I don't think. No budgeting whatsoever. And knowing that about yourself is going to be a key.
Yeah.
Doing this one.
So just to piggyback off that, we'll talk that a little bit more on the financial planning side, but having a broad financial plan, it also really helps you. I've seen this with several, countless clients of once you have that plan in place, it gives you an easier way to say, why you're not going out and eating all the time. It's like, hey, I have a bigger, a higher priority, which is, maybe buying a home, or if I'm thinking about my retirement. It starts giving you that why you're not kind of getting that instant gratification. You're like, okay, I'm not going to go out to eat tonight because I know that's going to add up to something more significant. Like we've ran it. We're like, hey, if you can reduce your budget by X amount, you can retire 2 years earlier. How does that sound? They're like, oh my God. And it's like suddenly do whatever, depending what job they're in, they'll do whatever they can to retire earlier. And then you kind of get on this budget. So I know we'll talk about it more, but I like this.
I think that's why setting that, the goals are, that's why we talked about that at the very beginning, because if you actually know what your goals are, what's important to you as a couple or to you as an individual, you're able to set a budget, because if you don't know what you want, you can't really set those goals. You can't really set those that budgeting because you don't know what's most important to you. So yeah, and there's a quick story. When I was like 19, 20 years old, I used to end up having this little thing where I had like 3 things written down, and it was right on top of my wallet. Like the second I opened my wallet, it was right there, and it was things like, again, I was 19, so like I wanted to go on vacation to California sometime in that year to visit family. I wanted a PlayStation, and I don't remember what the other third item was. But every time I opened my wallet to go get something, I would have to look at that list of the things that were important to me for that year. And I'm like, is this more important than getting a PlayStation? Is this more important to see my family in California? And the answer was no. Closed my wallet, and I walked away from the purchase. And it definitely helps knowing what's important.
Perfect.
Now, the key on this one is in setting a budget, there's a lot of different ways of doing a budget. Some people use like an Excel spreadsheet. Some people use you got like the mint.com, or a lot of banking apps have something. Or there's the envelope method where you just, every 2 weeks when you get paid, you end up taking cash out of the bank and putting into an envelope for your entertainment, for your groceries, for whatever that item is. But whatever system you use, if it's working, do that. I don't care what your system is. Just do the system that's working for you, because it'll keep you on the straight and narrow. All right. I don't see any other questions on the budgeting. Anything else before we go to credit? All right. So credit, we're going to talk about credit real quick and both how it impacts our lives. Obviously, it's going to have a pretty big impact if you're looking to buy a house. But even if you already own a house, why would it matter if you have good credit? First, let's talk about what credit is. Credit, for the most part, it's a report. It's a report card on you as a consumer. How good are you at paying other people back? Why would that be important? Because if you're someone like myself, we want to know how good you are at paying other people back, because we are about to be one of those people. If you're trying to get a credit card, you're like, well, I want to have something for the backup just in case of some horrible emergency. You're not going to be able to do so if you can't prove to that credit agency that you're good at paying other people back. And then later on down the road, if you are buying a car and you are having to actually get a loan out for that car, you're going to get really good interest rates on that car. In other words, not paying most of that money that you're paying these people just towards an interest rate. if you have good credit. So what's the first thing you should want to do to check on your credit? Well, I'm really giving you the answer in that question. You want to read your credit report. You want to find out what's on that thing. You want to find out if there's any errors on there on your report. Do you have maybe you went to the emergency room and they asked you for that $100 and you're like, okay, great. And then you got something in the mail asking for bills and you're like, oh, my medical covered it. Well, apparently it didn't. And you find that out when you pull your credit report and they send you to collections. So you want to make sure you're staying on top of that one before it actually hits any of that. And the only way you're going to do that is by reading your credit report. Now keep in mind, the only way you can actually pull all 3 credit bureaus, and those credit bureaus are Experian, Equifax, and TransUnion. So to pull all 3 of them, you need to go to annualcreditreport.com. It's the only place you can actually go where you can get that free credit report through all 3 agencies. And I do realize there's quite a few people who end up having things like Credit Karma. There's another one out there called CreditWise. There's numerous ones out there. And those are free, and they're fantastic. I have no issues with them. But they're not showing you all 3 credit reports. Usually they're just showing you 1 or possibly 2, but not all 3. And so you do need to see all 3 because if you were trying to fix your credit and all you've been looking at these 2 credit reports and you never even looked at the 3rd, when you're sitting down with someone like myself, or maybe you're looking to buy a car, maybe they're using that 3rd agency. I know I'm definitely looking at all 3. So you want to make sure that you're covering all of that by looking at all of them. And again, that is annualcreditreport.com. And it's actually, that's the one set up through the government to check that one. You should be tracking your credit at least annually, just to see if anything's populating on there you're not familiar with. How do you build your credit? Well, the best way to build your credit is pay your bills on time as best you can. Now, the good news is we do live in America, and I say this because in America, we go back about 7 years for most of our stuff. And in that 7 years, we're trying to figure out how you've done your credit. Why I say it's a good thing is because there are other countries that go back literally a lifetime. They go back 20, 30 years. So that thing you did when you were 19 years old, that, you're 19 years old, they're actually noticing that. So if you did do some things when you were younger, you can fix that over time. Now your credit is actually built up of several high-level factors that make up your FICO credit score. FICO would be Fair, Isaac & Company. That's the one that pulls all 3 of your credit scores. They're primarily looking at 5 high-level factors. The first one is your payment history. That's the one we just talked about. But luckily, that doesn't make up all of your credit history. That's making up about 1/3 of your credit history. 35% is your payment history. 30% of that score is amount owed. And really, this is talking about like credit cards. So if you have, say, a credit card that has maybe a $1,000 limit, how much of that $1,000 limit are you utilizing? And in general, what they're looking at is they're looking at certain ratios. Now, in general, you want to make sure you're always below 50% of that ratio. So if you have, say, a $1,000 limit, you never want to have more than $500 owed on a credit card. Anything over that 500 and it starts negatively impacting your credit score. Even worse than that is above 70%. Worse than that is 90, and by far the worst is 100. So if you have a $1,000 credit card and you've used $1,000, do you in fact owe 100% on your credit card? No, you owe more than that. There's this thing called interest. So now not only do you owe $1,000, you owe $1,000, whatever the interest is, and that means you are maxed out on your credit card. And the way they end up looking at that on a credit is they primarily say, well, you have $1,000, you're maxed out. It's like a nuclear bomb on your credit report. It's massively negatively impacting you. Getting a little bit better than that is 90%, but now is it like nuclear territory? No. Think more firebombing, think Dresden. Not a good place to be, but it's still better. You primarily want to be below that 50%. Better than that is below 30. Better than that is 15%. And by far the best under that 5%. That's actually a fairly recent one over the past few years. So all of my clients who have these credit scores are in the high 700s and the 800s. These are clients who typically have nothing owed on their credit cards or like under the 5% on their credit cards. And that's usually because they're maybe utilizing them, but they're paying them off every single month. Now, 15% of your score is length of history. So that credit card that you have had for the last 10, 15 years, you've had it forever, you don't use it that much, but you've had it, that's actually really counting positively on your credit report. I do have some people saying, well, maybe I should start canceling some of these extra credit cards I'm not using. I wouldn't recommend it. It's showing positively on your credit report. Utilize that good credit history. You've been paying it on time. It's been no problem. It's a very positive thing. 10% is mix of credit. I'm going to circle back around to that one here in just a bit, because the other one is 10% is new credit. And this sounds like it's not that big of a deal, but it actually is impacting you in two ways. Because one, you have it impacting you as new credit. This is when you get, say, a brand new credit card. It's impacting you because they don't have any idea how this is going to impact you. Like, are you going to pay this credit card on time? Brand new, we don't know. So it is impacting you, but it's not just impacting you in one way, it's actually impacting you in two, because now it's not only a new credit, but now it impacted your length of history. So it's not just impacting you by 10%, but by 25% on your credit history. Because they don't know, one, how good you are going to pay it back, and then you have no history behind this one way or the other. So for the first 6 months, it's going to negatively impact you as being a brand new credit card. After 6 months, usually it's not counting towards you, it's not counting against you, it's just kind of where you were before. After a year, it'll start counting positively towards you. And pretty much after everything, after 2 years, is just is where you get into high five territory. But when you're getting a brand new credit card, just know that this will have a negative impact on you in the very beginning. If you owe nothing on that credit card, it could possibly, sort of balance itself out. So where it's not really counting against you, it's not really counting towards you, it just sort of balances itself out. But you just want to make sure that you're being aware of that long term. And I did mention mix of credit. For the most part, I don't tend to think you should be doing too much with a mix of credit, but what they're talking about here is revolving debt versus, say, having a installment debt. And there's certain ratios they like to see. That ratio is usually a 1 in 3. So if you have, say, a car payment and a mortgage, how many revolving debts? This would be things like credit cards, maybe a home equity line of credit, maybe a line of credit that you might have had from your a bank or something. What is those percentages? So if you have, say, a mortgage payment, that's 1, and you have 3 credit cards, well, then that's a good mix of credit. If you have, say, 15 credit cards and no installment debts, well, now it's kind of out of whack. Is this having a massively bad impact on you? It's not. It's, again, just 10%. That's why I tend to say I wouldn't overly focus on this. It's more important to make sure that you're paying your bills on time and that your ratio, you're not owing too much on those credit cards. So, all right, who created the FICO? That's Fair Isaac and Company, which I just mentioned. What's that score range? The score range in general, lowest score you can have is 300. Best score you can have is 850. What do you really want it to be at? So in order to buy a house, you need a minimum score of 580 and above. To do most of the down payment assistance programs and have that sort of availability, you want 620 and above. But realistically, for most things, credit cards, etc., you want 640 and above for to be in a pretty good place. And really, high five territory is once you're at 740 and above. At this point, it's just, again, it's your high five territory. I have some people who are like, I want to get that 800, and guys, that's great. Is it going to really impact your ability to get a loan or anything else? Not really. Once you have 740 and above, any loan you could possibly want to get, you're probably going to be able to get just based on that credit score alone. They're probably still going to look at other factors like debt to income ratio and et cetera. But the point being is that that credit score is pretty much as good as it's going to get. It's not going to have that big of an impact, much above that. All right, so I have a client come into me and I pull their credit and their credit score says 600. And they say, yeah, but John, I wanted to do the down payment assistance. What can I do to improve my credit on the short term? One of the easiest ways of doing this is the example I have in front of you. So imagine I have 3 credit cards and each credit card has a $1,000 limit. Why? Because I'm trying to keep math simple for me. So I have a $1,000 limit. And of that 1,000, how much of that credit am I utilizing? So credit card number 1, I've maxed out. I'm at that full $1,000 limit. Credit card number 2, I'm only using 200 of it. And credit card number 3 is 300. And why? Who knows? Maybe you see credit card 1 has the lowest interest rate, so you're using that. Or maybe this is the one you get all your points from, it's your Alaska Airlines frequent flyer, whatever the case may be. And so that's why you're utilizing that. Well, start using some of these other ones, maybe just a little bit, because you can get all these below that 500. Sometimes you can do that by transferring from one credit card to another, or maybe you just stop using credit card number 1 so much and you start utilizing 2 and 3. But if you can get all those below that 50% mark, that alone will usually end up boosting my score by 10 to 20 points, like that, overnight. It can have a huge impact in a very short period of time. So this is one of the easiest ones that I can usually look at fixing credit.
John, can I ask a question? Can I ask a quick question on that?
Yeah, please.
So you're saying like literally overnight? Like, is there a look back if people are working on improving their credit and they sort of are in that situation, they could, I mean, as soon as they get there, the credit score will improve? Is it a
So the credit score won't show up on their side, but they can manually get it fixed. So the way that would work is I've had people who, I look at this and I say, this is what, pay off some of this one down to here, maybe transfer, etc. And so what they'll do is they'll get a statement, they pay it off, they go online, they get a statement, they print that off, or PDF, etc. Send it my direction, and then I will send it to the credit agencies, and then they will manually update their credit score, and I can usually have that done within about 2-3 days max.
That's interesting.
Pretty overnight. Yeah, it's pretty fast.
Yeah.
I'd love to say I was able to do that when I was at Wells Fargo, but we weren't able to do that when I was at Wells Fargo.
I think it's also just interesting. I know we'll touch on this a little bit more, like we were saying before, just having various specialists or experts in their field, because generally when I'm looking at credit cards, I'm thinking of, okay, which one's got the lowest interest rate?
Right.
Because I'm all about, if we're earning this certain amount of interest, if these different credit cards, what should we be paying off first? So it's interesting getting your perspective on what kind of moves your credit score.
Well, and there's other things that can also impact, like, so Dee Dee and I have a client right now where I pull credit, and the wife has fairly good credit and the husband has no credit. Like I pull a FICO report, Experian, TransUnion, Equifax, they have 0 score because he doesn't have anything on his credit report. He doesn't have credit cards, doesn't have car payment, nothing, which is great that he's debt free like that. But where the problem is, I can't get a credit score. So can he still buy a house? Yes, he can. I just have to manually build it. I have to get 3 different credits, such as rent. I think I've got a cell phone bill for him and a power bill. But I have to have 3 different things showing he's paid it on time for the last 12 plus months. And I can build a credit, and now he can go out and buy a house. A lot of people don't think of that. They're like, well, I don't have any credit, so I guess I can't buy a house. It's not true. If you have no credit, you might be able to build it for you manually.
Well, following up on
you have that conversation with your team of experts.
Right. Just last thing though, have you seen that situation where you might have a couple or partners where all of the credits under their name and the other partner doesn't have anything? I mean, is that that's something?
What I'll see on that is I'll see people who you'll have a husband and wife who are, and I usually find this to be brand new husband wife, because oftentimes whatever the husband is, the wife tends to be. Oftentimes most families, I tend to see they tend to stay in the same credit balance. So I'm usually the finance guy in my relationships, and so usually I have really good credit, and I usually help my significant other get their credit in line until we're usually on the same page. I tend to find that to be the case. But oftentimes I'll see one where, like a husband wife, and he comes in with a ton of debt and she has hardly anything at all, and things are off kilter. And oftentimes, again, it's just it's that beginning conversation, getting them both on the same page, just like that wish list. I think I'm set on, so I think I'm set on mine. There we go. So I know I'm set on mine. Hey, look, we can see us all. So I know I'm set on mine. So David, it is your turn.
All right, so we will do our best to share my screen and go from there. With a little luck, you're seeing a financial planning presentation. Does that
indeed
look good? Okay. So it's interesting. I think this has been great. I think this really kind of ties it together. Oh, well, I can already tell the importance of having a plan. So we're going to cover that. And then just really, we've already covered it a couple of times, but like having those wish lists or having kind of this budget, but really memorializing it, of having, it's been proven statistically, it's proven if you actually have a written plan, the probability of, if it could be your workout plan, it could be your nutritional / diet plan, it could be your financial plan, what we're going to be talking about now. If you have that in writing, the probability is vast. It's like 80% of the chance you're going to get closer to reaching those goals versus if you just kind of think about it. So I think it's actually beautiful you guys have been using that wish list and just really being able to put pen to paper and kind of go over what your priorities are. So yeah, I know. So kind of as we wrap up this presentation, I'm going to cover kind of broad planning and then spend a little bit just a little bit diving into, as a professional investment manager, and the things that I think about. Once again, as Dee Dee and I were talking through this, just the importance of educating the audience and educating individuals, of making sure you feel comfortable about taking that first step in regards to if it's buying a house or if it's putting together a financial plan. I know one thing Dee Dee also asks, like, how do you find an advisor or a trusted professional? In my industry and financial planning, and it can be difficult. So we'll cover that. So that's just a kind of brief overview. I do want to move my screen just so I can see you guys. You're on my other screens. Now I got everything right in front of me. So, all right. So with that, let's get started, or at least try to get started. I'm having tech issues, but that's all right. All right. Let's see here. Okay, perfect. So really, like I was saying, we're going to be talking broad planning. Really, I think about 4 steps. Just to kind of go through this, it's funny how you're hearing this repetition of so many of the same sort of, I like what Jonathan said, these pillars. Yeah. So you start with this honest conversation, and then where you're just discovering what are your priorities, what are your, we're going to spend a little time talking about common concerns, because I think oftentimes maybe that gets kind of pushed to the side as people really want to feel good about their retirement. But part of that is also wrestling with saying what keeps you up at night, what are you concerned about, and having that conversation and really building a plan that works for you. Because similarly, like I said, I know you guys hear it in your professions of like, hey, just give me the average. Like, what's the average price of a house, or what's the average mortgage? And it depends. I mean, similarly with the financial plan, like you said, oftentimes people be like, well, just give me a number of how much I need at my retirement date, and then I can retire with that sort of bucket of assets. It depends how much you spend. I mean, honestly, some of my happiest clients, they don't necessarily have the most amount of money, but they live within their means. And they're able to find value and find happiness in where they're at. And it's not necessarily just accumulating as much as they can. Actually, oftentimes it's finding that balance of having some accumulation, but also doing it in a way where you can still enjoy today and tomorrow, and not be too afraid of what the investment markets might do in the near future. And third, kind of how do you implement that? And we've talked on this a couple of times, of really building a good professional team around you, financial advisor, real estate specialist, mortgage, estate attorney, an accountant. All these are really important processes. And finally, just kind of tying it all back together. And it's an ongoing process. I mean, I really do love the visual of the wheel. It's not just a snapshot in time. It's taking a picture of where you are today. As Jonathan was saying, generally you want to review your credit at least once a year. I mean, similarly, you want to be reviewing your plan on an annual basis. Similarly, I know some people love to check, I don't know about love, but are somewhat drawn to checking the stock market on a daily basis and checking their investments similarly. So, it depends. Everybody's different, but once a month, every 3 months, once a year to get a handle. But that continuation is really, really important.
David, I want to ask, and I love this. Maybe I'll ask after you. No, go ahead into the next slide, because I see where are you. So I think I'll ask after you go through that next slide.
Okay. Great. Yeah. So I took the words right out of your mouth. Yeah. Where are you? So really that idea of taking stock of your situation. Oftentimes this is known as a net worth statement, where you try to put, once again, very repetitious, but put to pen to paper of where you're at. And I love what Jonathan was saying. Some people with their budgets, they have it down to the penny. They have all, whatever works for you. Once again, Jonathan, I love that. Whatever works for you, great. A lot of people, they'll get overwhelmed, so they don't want to take that first step. So even it's really broad strokes, depending, just ballpark what your your investment accounts are, maybe your home, other assets, putting it on paper, and then building off that to get a cleaner picture of where you're currently at. So like I said, the net worth, so that's for your assets and your liabilities. So your assets could be your home, liabilities could be the mortgage, syncing those up. Make sure that your plan, you have this cash flow. Once again, I love what Jonathan said of having a strategy of paying yourself, funding your plan. Then, like I said, the potential pitfalls in regards to that analysis. I've seen it time and time again where it can be overwhelming. A lot of people don't even want to talk about it at all. So it's like, thankfully, once again, you find a good advisor, you find a good planner that enjoys it, that ultimately wants to help you succeed. So to succeed, we need to know where you want to get to. And that last bullet point of that denial of just like putting it off, you don't have to do it all at once. So I don't know, Dee Dee, this is kind of this is the question.
So I'm gonna kind of dial in on this, right? So when I'm looking at this and I see 1,500,000, 2 million, to me this seems like a land far, far away. Like there's some sort of magical, I gotta click my heels 3 times. Suppose I don't have any assets. And the reason why I ask that is because sometimes when people come to me, they're just like, I don't have anything. I don't know where to start. Here's what I have. I have a job. Mm-hmm. And some don't have jobs, right? Some of them are like, I got laid off, or I'm in transition, right, to building this quote unquote life by design. I can see it. I don't have it yet. And, I help put them on a path to get there so that it's not in such a land far, far away. Right. And for some of my clients, it's 1 year, some it's 3 to 6 months. Some of them are right around the corner. Some of them, they really are carrying a heavy load. And my job is to really educate them, encourage them, and be a resource for them. So I guess my question is, suppose I don't have anything, right? Because then that might be a analysis paralysis or / denial that maybe it's not time for me to talk to David Cooper because I don't have 2 nickels to rub together to have this conversation.
That is great.
You know what I mean? Like, so when is it a good time to have this conversation?
Well, that is so funny you say that. It just made me think of, so my niece is great. She's in her early 20s. It's kind of interesting. Yeah, because, and I like what you said earlier, kind of like, you're never going to be at that perfect spot of like, okay, got all this money. Now it's time for me to find an advisor, or I've got all this kind of situation. If you start early, so once again, the 20s or kind of wherever you are, if you're just starting out, it's kind of like you have time to some extent on your side. Dee Dee, you and I talked about this a little bit of like the power of compounding interest.
Yeah.
Well, once again, we won't go deep into I know we've been at this for a little while, so we won't go super deep into the investment markets. Unfortunately, they don't just go kind of straight up. They've got some jags. If anyone's been paying attention through COVID, we had a big jag down. But in general, and Jonathan touched on this, the beauty of that compounding interest is unfortunately starts kind of slow. Like let's say you put in $100. These are just round numbers because similar to Jonathan, that's how my brain works. $100, you get a 10% rate of return. Now you got next year you've got $110. Again, you're compounding on that. It's interesting. Maybe, there's a mathematician out in the group. It's like once you hit there's a sort of an inflection point where it really starts compounding on itself. So unfortunately, like I say, if you're just starting out, you're not going to see like, straight up investment results, but you have that time where it's building on itself. That's kind of one component of, well, twofold of that importance of time horizon, knowing how long you're going to have the investments invested is really, really important. All things being equal, the longer you have to invest, potentially the higher rate of risk and return you could potentially put the money into. If on the flip side, if someone comes to you, Didi, and say, hey, I really want to buy a house within even 3 years,
Yep.
You want to be dialing down the risk in regard, lower risk to help protect what you have. Probably better than I do. If someone comes to you, they might be saying 3 years. When they find that dream house, they want to buy it like that next day. So you have to be, you kind of have to, you have like people, once they come to you, they're ready to buy. So I think that's sometimes a misperception of,
right. It is.
Yeah, I need to invest today because I need like double my money or whatnot because I need it in 2 days. You've got that backwards. Once you kind of need the funds, you need to sort of factor that in and make sure that it's accessible to you. Unfortunately, we had some people, they weren't working with us, but we've heard some nightmares, people that they're much more aggressive than they thought in their investment account. And unfortunately, when they needed the funds in the first part of 2020, a lot of it, they'd lost it. So does that kind of hit your question about like, even if kind of circling back to what you were saying, there's never like a perfect time. Again, it's like the land far, far away. You got to start that first step. And I'd say like, so the foundational step is take stock of where you're at and say, even if it's a small amount, it starts compounding on itself. And then it goes to that budget. I really like what Jonathan was saying earlier, put that budget in place. And then, like I was saying earlier, it's like, okay, now I know why I'm trying to save some of this money. If it's for a down payment of a home, or maybe it's to help my kids with college, or if it's to potentially retire in 20 plus years. Mm-hmm. And also, once again, piggybacking off what Jonathan was saying, oftentimes there's these various either programs on the home purchase or in retirement. You have a variety. We're not going to get into details, but there's a variety of different types of investments that primarily have a lot of tax advantages. You kind of have these carrots, so they're going to help you with your retirement, and you get a tax advantage. You do have to be mindful that there are also restrictions. So those are just kind of layering on your knowledge is kind of the first step. Good?
That's good. Yep.
So moving on, it goes back to what we were saying, and just to think this through is really the idea of having those goals. Everybody's priorities are different. Like I said, everybody's priority on what's important in their home is different. Similarly, I don't think people should get kind of swept up with what somebody else's plan is. Yeah. Whatever your passions are, whatever your plans are, however you really want to live this life, go for it, and then put that down. The idea, what are your priorities? This is what I was saying earlier before, really talk through the concerns. I mean, oftentimes we're talking about retirement planning. You guys, a little quiz to the two of you. Do you know what the number one pitfall is in regards to derailing your retirement? So once you're in retirement, what is percentage-wise, what's the biggest could potentially, send you into bankruptcy?
I'm gonna have to say medical. Medical is probably the biggest pitfall in retirement that can absolutely derail you and drain on you.
Yeah.
Is it? I was gonna say some sort of like not enough residual income.
Well, it's primarily, that's if you've done the income, but it is, Jonathan's right, a healthcare issue. Because oftentimes, and that's a whole conversation, that's a whole nother presentation in itself. But oftentimes there's a disconnect on what sort of Medicare pays for, what it doesn't pay for in regards to long-term care. Like I said, that's a whole nother conversation. But you need to educate yourself or have an open, honest conversation with folks, specialists that can help you talk through that. So then you're aware of it, and then you can potentially manage, you can reduce You can't reduce every risk, but you can help manage it. So then that's really, once you've put that kind of where you're at, where are you trying to get to? And it goes back to what I was saying before, then it becomes trade-offs. Some people will say, hey, you know, I don't have as much as I need. I mean, we've had honest conversations with clients say, hey, you are going to look, you're going to set yourself up for success. You know, we change some of these priorities, maybe retire a few years later. You know, that some people are okay with that, because it's also interesting once you have a plan on paper, people literally like see this light at the end of the tunnel, say, okay, yeah, if you're telling me it looks better if I retire, you know, at 68 versus 65, all right, at least I know there's kind of a plan in place, literally. And it's like, I can get through, you can literally see like the weight lift off their shoulders when they start saying like, okay, I've got a plan. And then there's all these kind of other things.
Some of the other concerns I know I've definitely heard a few times is, will I have enough to last long enough? Like, this is a retirement that'll last until what? I'm 80 till I'm 85. Like, when am I going to run out? And, you know.
Oh, great question. That's what, and I was on a call earlier today, very, very similar. We actually, with generally the plans that we run, we're very, very conservative. So life expectancy that we're using is DD, it's 95 for women, it's 92 for men.
Oh, women live longer, huh?
Yeah. It's statistically, and it's also just, we want to be that, when I say conservative, because that is longer than if you were just to Google, you know, average life expectancy, but we build that out longer, almost as a safety net in regards to making sure, Jonathan, I mean, that's a huge concern. Like, the statistics show the biggest concerns for people are, A, they don't want to run out of money, he said. B, they want to make sure that they can age properly in their home. So DD, making sure that they're in an age appropriate, like you said before that, you know, single layer, the Rambler. So that's the second concern, whatever that may be. Different people feel differently about maybe retirement community or some other type of retirement home, but just being comfortable with where you're at, that takes planning. Generally, it's been proven, generally, you don't feel like it's your home until you've been there for 7 years. So the last thing you want to, you know, have is a situation where all of a sudden something happens and you have to immediately make a decision. Your home, the, you know, 3-story townhouse is no longer conducive to your situation.
Right.
You never want to try to make really big life decisions in a crisis.
Right.
Yeah. And then the third kind of concern of people, they don't want to be a burden. They don't want to be a burden on their loved ones. They don't want to be a burden on their support group. So kind of planning that through. And that's a lot of having that conversation around concerns. And I think that goes back to the importance of finding a good advisor. And like, we're not just talking about, oh, hey, this is the next newest and greatest kind of investment strategy. Let me tell you about how great it is. And say, hey, let's be real here. We want you to be successful for the rest of your life. We have to talk through some of these concerns. So let's see. Yeah, well, perfect timing. Talking about building out your team, because I think, and I guess this is a little bit of like, I don't want people to like be blown back like, oh my goodness, I have to have this huge group of people that kind of come in and out of your life. But I work closely with attorneys, you know, estate or accountants, real estate agents, and mortgage specialists, insurance. I mean, actually, Dee, when you're saying, hey, if you're just starting out, I think educating yourself on insurance, be complicated, but once again, you find a good insurance specialist. It's really important when you're starting out, like term insurance. That's really, you'll probably, hopefully, cross your fingers, you'll never actually need it. But it really is what it's there for, is to somewhat insure your income or income that you would have potentially earned for you and your family. Yeah. The one, and this is because I'm affiliated with a couple of different broad planning groups. The very last one, are you guys aware of what a geriatric care consultant?
I was going to ask about that. I have no idea what that is.
It's fascinating. It's like, oh, I'm sorry, Jonathan.
You're good. One of the things I wanted to end up putting out there is, there's an elephant in the room here, which I hear a lot, which is like, I get a lot of people say, yeah, I've heard of all this, but this is what rich people need. Like, this is this whole team thing, that's a rich people thing. That's not like regular people thing. And I'm like, no. That's a regular people thing. Like,
Well, it's
Well,
interesting.
if you're a regular person, you're going to need a financial advisor to figure out, you're in your 31, you haven't really looked at your long term for retirement. That's going to be something you're going to want to talk to down the road to get that plan in place. You're looking to buy a house. How are you going to do that, et cetera? That's a conversation with a real estate professional, with a mortgage professional. I guarantee you probably have insurance right now. Who do you have as insurance? Do you have a gecko, or do you actually have a live person that you can talk to?
well, and I think what's important too is like when I think to the average person, when you see all these people, all you think of, oh my God, this is dollars going out, right? Like this is money going out. This has got to be cost to be X amount of dollars a month. And I think that is a misnomer and a misconception when it comes to that, right? Like nobody works for free, of course, or volunteer these type of services, but you almost can't afford to not have higher right. I actually just got a text from someone who was asking me about, reducing my fee or my value, right? The value of who you hire matters. And you really do get what you pay for. So if you're looking for this discounted, financial advisor, what you're doing, right? And to be able to put your family's life, your real estate, your mortgage, your financial advisor in someone's hands, you got to really count up the cost when you're thinking about hiring these discounted people, because these are some of the biggest investments that you're going to make.
Yeah, I totally agree with you. You pay for expertise, and it's interesting, and you can, but yeah, and I don't, it's funny, back to Jonathan, he said, like, yeah, maybe a Bill Gates has all of these people on staff. These are more like, you can have, these are people that come in and out of your life. And I'm sure, like Dee, when you have a positive impact, someone with their home purchase, I mean, they know, and they kind of, they're your best advocate are your existing clients, right? And so it's a great way to build, and we're all in it we want to help our clients. We want to see them succeed. If they succeed, we succeed. Right. And then back to like I said, the geriatric care consultant, this is real quick, and then they're actually a group that will come in, they'll look at your home and see if it's age appropriate, if there are some cognitive issues going on. They can start, they're preventative. I think so much of our industry, or not our industry, but sort of our situation is reactionary. And this is just a minor shift to start looking a little bit proactive. You make that decision, and then you'll start seeing how things will start falling in place to some extent. So, really good conversation.
Yeah.
So, like you said, kind of the idea of, we've gone through, what does your situation look like? Then it's the idea of building the plan. And I think it is interesting, building off what Jonathan has said before on the budgeting. Sometimes it's not a huge shift. It's some minor adjustments, and then you go from what we're looking at, not to get deep into the statistics, but it's sort of running these analysis, your probability of being successful in, if it's, buying a home, if it's buying kids for college, long-term retirement, kind of, okay, what are our probabilities of being successful? Once you start listing what your priorities are, you can start making some trade-offs. So it's quite impactful. Like I said, where we're headed, where do we want to get to? It is nice, like that, you take ownership of really what your situation is, and it starts driving you. It goes from, once again, I've seen the shoulders lift when people start feeling better about their situation, or at least having some clarity. And the same sort of thing, I get the shrug all the time of like, when do you want to retire? Oh, I don't know. It's like, it's just almost like, once again, it's overwhelming. But if you can just start like, oh, okay, like if I get the shrug, I'll generally start with age 6. Well, let's think about 65, because that's Medicare. At least it gets the ball rolling. And it's like, okay. And once again, I know a lot of times people want generalizations. Everyone's situation is different. But generally, speak with your financial advisor about this, but generally whatever you're spending in pre-retirement, you're going to spend approximately about 80%. Granted, you still need to run plans, but that's at least gives you a ballpark. Because I think that's what people want to start with. They're like, okay, I just want to be in the ballpark. And back to what you're saying, Dee Dee, if you start small steps and start adding to it and having some success, that's where you start getting that inertia and getting that compounding interest. We've talked about this before, that procrastination. We are going to shift a little bit and talk about investments. So like I said, we've been at this for a little while, so we won't go super deep into it, but maybe dispel a couple of, myths, and then talk about what I think about as a professional investment advisor.
Yeah.
So Niall, we've talked about that a little bit. So let's just talk about investments, or because I'm going to jump to kind of some more best practices, but there are a lot of things you can do. And we talked about it already. I'd say once again, the first thing is to chat. If you're working with a company that offers a retirement benefit, chat with them, or benefits in general. Like Jonathan was saying, oftentimes you may not know this, but your company might offer an insurance policy for you. Oftentimes can be a factor of what your average income is. Just looking at it's really quite inexpensive. And yeah, it's good to start with your benefits group. I think oftentimes they get overlooked. Everybody's so busy. You don't have time to kind of take a breath and chat with your HR group. Actually, I'll quiz you guys. Have you guys talked to your HR group at all? Like Jonathan, I know you learned that you had 3%.
It's funny because one of the things that I looked at was, I think it's every 2 weeks I pay $1.92 for basically $100,000 of life insurance.
Yeah.
It's $1.92. Who cares?
Yeah.
It's perfect. And, it's just one of those things that you pay attention to. You're like, yeah, I want to end up having this covered. And then I also end up having coverage outside of that because, God forbid I were to lose my job, or I don't know.
Right.
I want to make sure that I was still covered. But again, you don't know that until you have those conversations.
Yeah. And for me, being an independent contractor, I definitely have the life insurance, and Keller Williams does have, I believe they have a program that they don't match dollar for dollar, but there's a percentage that they will match for like a 401k or an IRA. So that definitely is on the docket for sure.
Yeah, that's interesting. Like you said, because I'm also an independent contractor. Yeah, you kind of have to be very, very vigilant about your taxes, about all the big stuff, the big grown-up stuff, the taxes, like I said, the insurance, the retirement. Yeah, you got to stay vigilant. So now we are going to shift a little bit and talk about, so we've talked planning. Like I said, I think oftentimes, I think a lot of times, like particularly if you're just starting out, it's like, I just wanted the kind of money invested. And you got oftentimes, when you take a step back, you say, okay, what are your goals? And have that conversation. You can, always welcome. I can be a resource. You can always contact me. I'll have my contact info at the end of the presentation. But yeah, you can go online and start. You don't trust everything you see online, but you can start finding maybe like a financial planning platform to use. But yeah, actually, Dee Dee, back to what you're saying, you get what you pay for, kind of free, quote unquote. There's always something behind it. But like I said, I'm happy to be a resource to help you out, kind of get you moving in the right direction. But yeah, let's just switch a bit. So now let's talk investment management to some extent. So this is one of my favorite sort of the next two are my two favorite. They're very, very colorful. But what we're looking at here is what's known as the efficient frontier in investment management. And the idea of you go from left to right. Left on the graph is very conservative, even like cash. But then if you look at the, what are we talking, the y-axis, the one that goes up, I guess, is the potential rate of return. So anyone that's so what's really, really nice in Jonathan's world and in Dee Dee's world of interest rates are incredibly low right now. So you have, incredibly low ability to go out and hopefully borrow money. The flip side of that coin, it's incredibly low savings rates, as you may or may not know. So the idea, if you're on the far, far left, for all intents and purposes, a savings account, you're earning close to zero. But as we trend to the right, we're getting, and I think this is also, I hear this all the time of when people talk about, well, investments, they're like, oh, it sounds really scary. Like, I don't want to be in the stock market. There's a whole spectrum of different types of investments from, well, savings account, lower risk bonds, a whole variety of different types of bonds. And you start talking about stocks, which are really, really minor ownership of a company. And then all the way up to the extreme of owning a high risk, 100% stock portfolio. And that's, as we were saying earlier, you sync that up with, A, what kind of risk can you handle? B, what's your time horizon? If you need these funds in the next year, you know what? Even if savings rates are zero, that's really where your funds should be, because you don't want to be potentially putting that principal at risk. So you can see the kind of top of this page, that idea of risk. So that volatility. So again, if anybody was watching the news, or the stock market was down over 40% with COVID, and it looked bad. It looked real bad. But I think that's also where a good financial advisor steps in. We're able to have some strategies that, by having a blended investment, some stocks, some bonds, that 40% wasn't nearly as significant for a lot of our clients, because we know it's almost, ultimately in my world, it's harder for me to have a conservative, or it's harder to have that conversation with a client. Like, if Mr. and Mrs. Client, you're retired, I know the bonds aren't earning very much, but they'll help in a time like Corona or the COVID, you're not going to lose as much. So I think this is really, really impactful. So Dee, going back to what you're saying, hey, if you're just starting out, what can you do? Over the last 20 years, they've had the investment market has quite a few offerings of very, very low cost, what are known as asset allocation funds or asset allocation investments, where just kind of one investment, you can be in a moderate conservative investment, or a conservative investment, or aggressive investment. You can kind of put that money to work. Still, with the caveat, I highly recommend having a plan, working with an advisor, but granted, I'm biased. And I think some other thing people are like, okay, once again, what are just realistic returns? I mean, generally, anything over 10% on an annual return is really taking on a lot of risk. I mean, we're on the bright side, if you can handle that risk and you have a long time horizon, you can generally expect the stock market, we'll talk about it a little bit more, has averaged.
I know that typically that's a really important conversation in the very beginning of what's your risk
tolerance.
What's your comfort zone for risk? Like, are you comfortable with a moderate aggressive? Are you comfortable with balance? But I also know that in general, usually what I tend to see is that a lot of times it has more to do with age. When you're young, you can be a little bit more aggressive because you have more time to mess up, honestly. And I know that a lot of my clients who are older, they tend to have a lot more conservative setups for their retirement. What do you tend to usually see on that?
No, you're exactly right in regards to, and it goes back to the plan of, say, hey, ideally we want to be able to reach our rate of return with as little risk as possible. So we kind of run those numbers and we work with the clients to A, have that plan, and B, sync that up with the right type of investment portfolio. So if you're looking at the slide and the balanced portfolio, so that idea is about 50% stock, 50% bond. You'd expect to get about half granted, no guarantees here, but generally that type of return historically on an annual basis is returned about 5%, give or take. The nice thing is, in the early part of this year, COVID, that instead of that portfolio being down 40%, so if you had $100,000 in it, it didn't go from 100,000 to 60,000 in a matter of weeks. You would have had going from 100, something that would lose about half of that. It still doesn't feel good. Actually, I like a really good example. Oftentimes people think about like a roller coaster ride. If you're in the upper right, you're getting a whole lot of action. You got your corkscrews and your loop-de-loops, and you got a lot of excitement. versus if you're on the far, far left, you're kind of in that kitty, maybe a little bit of ups and downs, but in general, no, you're right, Jonathan, of like, not always, but generally.
For Disneyland, you end up having Space Mountain as the aggressive side, and
Yeah.
Conservative is the people mover. Okay.
Yeah, exactly. Yeah, exactly. So, but I love that. I love this graph. Besides the pretty colors, it does really tell a story. Hey, we have to match up what you're willing to, what your comfort level is. Granted, there's usually like, I want to take no risk and have a really high rate of return. Then we have a conversation of like, we have to continue that education of like, well, this is what you can expect from the markets. I think oftentimes I've seen this in the industry. If people say, hey, I want no risk and a high rate of return, you'll have some unscrupulous people that will try to paint a picture of that's possible. But in reality, it's educating yourself and empowering yourself of knowing what's feasible in the market, and you're less apt to be taken advantage of. So great conversation on there. If you like colorful charts, you're going to love this next chart.
I was going to say, I feel like the last slide, I was on mute, is definitely that's a whole nother conversation. That's a whole,
conversation on its own.
That's an hour conversation on its own. I think that people would be interested in, later on down the road, for sure.
Yeah, like I said, I know we've been at this for a while, and people are just like, oh my gosh, I'm sorry, I just love it. I think there's this whole world out there of kind of arming yourself with the education of, it's not incredibly complicated. I think unfortunately, the financial services industry has made it unnecessarily complicated. If you have a plan, kind of a long-term financial plan, we can build an investment portfolio or investment strategy that will sync up with that or kind of help you reach those goals. And then you kind of stick with it. And then we'll get to that. So like I said, in the interest of time, maybe we'll have to have a second presentation where we dive a little bit more into this. But
it's funny because it really does make a lot of sense, because you have, let's face it, you just did the Space Mountain, you just did the splash one, you ended up doing the cool Star Wars one, and now you're hot, you're tired of the lines.
Yeah, exactly. Like,
a lot more.
So this is so once again, it's a little quiz. That last one was known as the efficient frontier, because you really want to find that balance. This next asset allocation, here we go. So this is known as the quilt chart. In the
well, that's not intimidating.
It's so you're like, just the idea of quick explanation, and it's a beautiful thing. What we're looking at from the far left is 2008 all the way up to 2019 on various types of different investments and how they've done against each other. Now, I won't go into deep detail, but it's interesting. I guess it's also the behavioral investing, because if you look, real estate. So when you see this kind of orange box, that REIT, that stands for Real Estate Investment Trust, a REIT. So if you look at it, just track that orange box. And this is unfortunately historically what investors will do. 2008 hit. If we can still remember back that far, I mean, that was the worst of the worst. 2008 hit, real estate was down 40%. So people are like, oh my God, I have to get out. I can't handle this. So they get out. Then all of a sudden it's up 27% in 2009. Another 27% in 2010. People are starting to think about it, and then, still positive return. Then people start chasing it, and then they'll get in and they get 2% return. They're like, once again, this roller coaster ride. So again, it's a little hard to see, but there's also a box called balanced allocation. It's highlighted. You can see it sort of trends. It's never the highest, but it's never the lowest. So it's oftentimes having that blend of a variety of different types of investments and in different styles and strategies is ultimately going to be everybody's different, but it's going to be a good solution for a vast majority of people. And generally, we don't recommend anybody have more than 5% of their investment in one particular company. I know everybody, we live in the Seattle area, so Amazon, Boeing, Nordstrom's, everyone loves to own local companies. But once you get over 5%, you're just taking on a lot of risk. And it's really, one of the harder things is selling out of a position that's done well. Because you can always sort of explain why it's going to continue going better. I don't know if anyone's ever heard the adage, buy low, sell high. Unfortunately, people historically will buy high and then sell low, because they'll kind of hear of the hot new thing, doesn't work out for them, so they sell, and then some unfortunately go on to the next hot thing. But if you have a plan, financial plan, you're like, oh, I'll just stick with my plan, and I won't get as kind of laser or tunnel vision into a particular strategy or a particular company stock. So questions on that? Like I said, I know
fascinating. This is like, this is a whole nother class. Like you could on our next one. Yeah. This is fascinating.
So then as we're kind of sort of wrapping up, and I think it does go back to hopefully kind of this, okay, planning. And in the start, so what we're looking at here, and I promise this is the last sort of like over the top chart, but just that idea of staying in. Well, first of all, I just hope very, very few people have ever been successful doing what's known as market timing, where they'll get in and out of the market and kind of, so the idea of staying in and sticking with it, because we've seen it just in these last couple of months. We had some really bad months, and now we had some really good days in the stock market. It's still a bit of a mystery why the investment markets have been doing so well. And, actually economy, there's still a lot of concerns. Unfortunately, a lot of people out of work. And that's, once again, that's a whole nother conversation for a whole nother day of, what can we expect over the next year, 2, 3, 5 years? But goes back to, okay, how long can you have the money invested? If you need it in 3 years, you probably should be quite conservative. If you need it 20 years for retirement, then you can be more aggressive. So as we're kind of wrapping up, and I know we've touched on this before, you don't need to have all these people at one time. You don't have them all on the payroll at the same time, but just know that it goes back to, okay, how do we trust these people? I know if kind of dialing into this call or dialing into this presentation, probably already working with me, Dee, or Jonathan, or the combination of us. So help us help you by introducing you to some of the other professionals that we truly respect and would want our own clients, friends, and family working with. These are all different areas. And then this Dee and I were talking about this at the beginning, like, okay, how do you trust your advisor? So now you've got 3 pieces of homework. You're going to chat with your HR group or contact them to see what your benefits are. I have 2 questions when it comes to really finding, in my humble opinion, as a financial advisor, I've been in the industry for over 20 years. There's really 2 questions. So the first is, all right, do you work for what's known as a broker-dealer or a registered investment advisor, or what's known as an RIA? It really should be an RIA. That area is getting broader and broader. And what that means is a registered investment advisor has to follow the fiduciary standard, which puts your interest first, you as a client, today, tomorrow, and the future. And also really is crystal clear on, okay, here are the benefits, here are the risks, and here are the costs of any type of strategy that we're going to do. Oftentimes that can be very, very difficult to tease out what the costs are. I think, like Dee, you were saying earlier, ultimately people know you have to pay for good advice, but people want to know what they're paying. They don't want to be kind of, just tell me what it is. And that's how, and like I said, granted, I'm biased because I am an RIA, but I did it for a reason. I made a decision because I think that's really what people want. That's how you can be more impactful with your clients, is being upfront, providing a plan, having the everything up front and explain. I think that segues into the second question. Do you have a written plan for all of your clients? And once again, the answer should be yes. You want to make sure that your advisor knows where you want to get to, and they can help you do it.
That's good.
I mean, once again, so, and then this kind of finished sort of this off with a quote from Yogi Berra. Like, you know, if you're making really good time, back to like the investment, if you're making really high rates of return, but you don't really know where you're trying to get to, that's not a good thing. Like eventually that's not going to end well because you don't have kind of a longer term plan or a broader plan. So yeah, kind of like wrap up.
That's across the board for all of us, which is that it's important to know what your goals are, what's most important, because we like to think that it's a point A, B, C, and it's not that way. You know where you want to get to, and then you tend to do a lot of this to get there. You have to, you know, make some adjustments throughout to get to your end goal, and that's okay.
Yeah.
If you know what your end goal is, we can usually help you get there. But if you don't even know where that end goal is, then it's really hard to get the rest figured out.
Well, and I think you have to start where you are, right? And wherever that is. I don't care if you have $20,000 in the bank or $2 in the bank or no bank account, right? Like you have to really, sometimes you have to just slow down because life is going to continue to happen, right? And it doesn't slow down. Time stops for nobody. But if you can slow down enough to think about, where do I want to be in the next year? Where do I want to even be in the next 30 days? What can I do? You know, you don't have to arrive to talk to any of us. Like we will really meet our clients exactly where they are. And I know that not everyone operates that way. Right. So it's come back when you have $20,000 in the bank, come back when you have A1 credit, because I don't work difficult lending files. You know, David, come back and talk to me when you have assets that we can talk about. None of us on this platform are coming from that place. Again, and I go back to how we were originally structuring this. We had to blow that up because we needed to make sure that what we were talking about was relevant for today's time, right? Like we are really kind of up in arms in America right now. And so we are coming from a place to, hey, start where you are, whether you have a lot or whether you have a little, whether you feel like you're too old, which is not a thing, whether you feel like you're behind the 8 ball or, you know, I've got money and I'm ready to move on to the next, you know, what does some maybe aggressive investments look like? Like we're here wherever you are, and we can actually help you maybe ask you some questions that are going to bring out your real why. Because sometimes you can get in life and you just kind of get lost in life. I don't really know what my goal is. I don't know where I want to be. I'm just trying to make sure that I have dinner on the table and that these bills are paid, right? So, but you have to have advisors. You have to have people that can kind of snatch you out of time just for a little bit to consider some different perspectives that can help you get out of the day-to-day and start walking you towards some of those end goals that we can help you discover.
Agreed.
Yeah, I love it. Like you took the words right out of my mouth with the, we'll meet you where you're at. And I like to think all of the professionals I work with are the same way. And I think hopefully, you know, people can catch that, or they pick up on that. I'm like, okay, they're here for me today. And I know that they're ultimately trying to move me forward to what my ultimate goals are. So no, that's great. So kind of just wrapping up, I think it's been really fun kind of going through this. I think it's really interesting how so much of it piggybacks off of each other. And I mean, I learned a ton of stuff in regards to the budget and the credit, but I've said it, I don't know, there should be some type of, we've said planning probably 100 times.
Yeah.
So plan, at least for me, I mean, much more broad. Like we could scratch out, you know, investment and just say your strategy. You know, what is your strategy for home purchase, for, you know, mortgage? For me, it's on the investment side. I really like those next steps. Once again, well, investments, but just more broadly, like let's help you educate yourself on different topics that are the highest priority for you today, tomorrow, and the future. Finally, like I would say, I'm sure you two are the exact same way. You'd be happy to chat with anybody. Once again, Dee Dee, perfect, like meet you where you're at. in regards to questions you might have, and we'll get you moving in the right direction. So that's what I had. And then, yeah, I've got my contact info. Feel free to give me a call at 206-531-0117 or email. And I'm happy to spend the time to make sure that you're doing everything you can.
So thank you everyone for attending. I hope you guys all enjoyed it. If you have any questions down the road, please reach out to us. We will end up having our contact info at the end here, so you can end up seeing that hopefully right about now. If you guys do end up having any questions along the way, please do reach out to us. We're always happy to help. We are here for the long term. I know both Dee Dee, myself, and David, we have been helping clients along the way from the very beginning all the way to the end to both getting their houses and everything else for years on end. So we're not just that person that's helping a little bit. We are going to be helping for the long term. So I look forward to being able to help. Thank you guys so much again, and hopefully we'll be able to do this